First primary factor is the dollar. Gold has made new highs in terms of the euro and the yen, and virtually any other melting currency on the planet is doing what it's supposed to do. It's not doing well in terms of dollars in the U.S. because of what the Fed's doing. I mean, they've raised how many, 300 basis points this year? That's a significant amount. Why would you want gold when you can get T-bills and get right now 4% in a 2-year note? So the only thing that's constant in life other than death and taxes is change. And obviously, British Empire is no longer an empire, but you intrigued me to pull up the chart of the pound, and I've been involved with the pound for many years, but our chart in terms goes back to 1971 and has that clear trend of anything versus the dollar in history. The dollar goes up and it goes down. I mean, all fiat currencies have that trend. Now, maybe one, Swissy, goes up, but any kind of basket goes down. And to me, this is actually the all-time low. The key reason why I've been a perpetual dollar bull, if people have called me, because the one thing you will look at is the number one thing that really is a factor for shows maybe a leading indicator factor for the dollar is if you look at U.S. equities divided by the world ex-U.S. equities, that trend is linear relationship up with the dollar. When you look at the dollar, it's just the worst of all except for all the other ones. And the key thing I like to point out is we will at some point get a dollar correction, but typically the dollar never goes down unless it goes up a lot. It's unstoppable right now until you see the lose-lose situation of U.S. stock market going down, which is part of my lose-lose for the U.S. stock market, because everything's starting to break, just not the big stuff. It's broken in cryptos. We've seen that. Now, that's good because cryptos are top leading indicator. Governments will always print more money to help solve their current domestic problems. There's a big problem in UK. They're going to throw more money on it. They're going to create more inflation for them. The cool thing I love about free trading of currencies, it's the currency vigilantes. You pound that currency because it's showing that the global market does not agree with your policies, at least in the short term. Now, I don't see what ends this trend. I'm sure it's going to bounce in the short term, but right now it doesn't look too good. And it's just how you're measuring the pound versus the dollar. Dollar is another fiat currency. I just pulled up the chart as we were looking at UK and the IMF foreign reserve exchange holdings. The key thing is, as far as relative, I don't know so much, but I see a trend going from the lower left to the upper right. It's actually been collapsing this year, but it's still much higher than it was just a few years ago. I think the more significant thing early on, because of all the monetary or the fiscal stimulus, that the Bank of England is going to have to offset that. Right. It's just how it works, which is lose-lose. But that is part of the reason for this separation and the independence of the. We're just waiting for something to break. It will happen, maybe a significant emerging market defaulting on their debt. But this is usually how it happens. When you see the yen up 20% in 1 year, the euro 15% down in one year, the dollar index up 15% in 1 year, that's breaking the world economy. That's your global depression. And I didn't say recession. We're still we're tilting towards. It's just a matter of time until something breaks, until something gives up and they have to provide liquidity. But it's happening in real time. We all know we're heading to recession globally. We all know what's happening in China. They're plunging. They have a property crisis that's much worse than ours was in 2008. People are blaming it on coal. Key thing I want to point out is, having worked at primary dealers all my career, is the Fed virtually never discusses the dollar at their meetings. That's what I've got from my Fed watchers. That's not a key. It's not part of their mandate. Dollars is something to watch. But if it makes something break, they'll watch it. If the global economy is collapsing and it's going to make the demand for kick in deflationary trends, which I fully expect, then they'll notice. But right now they're job owning, and they're doing a good job of it. Prices spike. The Federal Reserve and every central bank in the world followed that with inflation. Oh, we have to hike more, and now it's going to come back at the fastest pace, I think, in history, which means we're going to go into significant deflationary period. Strategic Petroleum Reserve anymore is to help protect us against things like hurricanes that are coming towards Florida and stuff right now in the Gulf, because it is redundant. The U.S. now is the net largest producer of energy and agriculture, and we have the power to, and that's just by slightly adopting this advancing technology. And it's nothing that it's supply going straight up, but actually consumption has been declining. It peaked in 2005, liquid fuel consumption in this country. So to me, that's what's happening in this global space, the SPR, and the political forces help that. But in the big picture, Biden is toast, the Democratic Party is toast, partly because they lean too far to the green side. And that's what I loved about, it's nothing perfect, but perfect. I was hoping, focus on the current situation, bring on as much supply as possible, and then help the renewable energy factor. But just by normal rapidly advancing technology, we're going to replace fossil fuels with with technology. That's a quote I heard 10 years ago. And that's for me, I have an electric car. I have 2 electric bikes. I powered my house with solar power. I had most of my heat from wood, but I still had hooked up to the grid and still really appreciated when things got really cold, I can kick in that heating oil and I have a grid all the time. You have to it's just that organic trend has completely accelerated. Now, Europe's going through pain right now, but when they look back at this 5 years from now, they're going to say, thank you. Now we've transitioned so fast. We use less of fossil fuels. We can create more of it we want, and we are really focusing on all the renewables, and storage is going to be a key thing. I typically like to watch the Federal Reserve's calculated trade weighted dollar index, because it's about 20% to China's yuan, because it's what really matters in terms of global trade. And the thing I like to mention about the DXY, you just inspired me to do this, it's relative movements that matter the most. And right now, the DXY relative to its 100-week moving average is 18% above that. It's only happened once in history, at the peak in 2015, right before the collapse. So it's pretty well extended. 100 weeks is pretty standard. It's almost 2 years. It's 2 years. But that's the relative strength of it. The U.S. stock market going down relative to the rest of the world. Yes, there's other things in the big picture, but that's been one of the key drivers over time, is the U.S. stock market outperforming the rest of the world. Now, yes, it might be a little bit lagging when people start taking their money out of U.S. assets, but where are they going to go? Honestly, okay, in the short term, even the bond market, it's the lesson I learned trading treasuries years ago. There's no bond market in the world that's even close to the U.S. Depth, security, volatility, getting 4% on a 2-year note right now. Thank you very much. I mean, what person in the world is not going to do that? So people only sell treasuries because they say, oh, they have to. And so I look at it as this is part of breaking right now in this rest of the world. This is part of, to me, is going to be the Great Recession kicking in this year. I'm calling 2022 the Great Reversion. And I view this as very similar to 1929. It's a good point to say it's less likely to see a crash in U.S. equities, but typically dollar flows will flow to fixed income T-bills and 2-year notes. Not really long bonds, but when you can get literally 4.3%, I pointed this a few months ago, is the highest rates in the world, the deepest bond market, and most likely that inflation is going to collapse is in the U.S. I mean, I go back to 1960, and now we're in the middle of the biggest dump. We're taking liquidity at the greatest pace ever. Now, I'm only 60, which means risk assets have to go down. So it's that, that sugar high that every single time the market went down 20%, the Fed would ease, is going away. So people get that. There's sellers up above in the equity markets. The mature long-term rational money managers understood this punch bowl is being taken away, and the party lasted for 40 years, so it's going to last a while, and it's very likely to head towards recession. The beginning of an enduring deflationary recession in response to the excesses of excess that peaked in 2021. Cryptos are a good part of that. They went up the most, they've gone down the most, and they're probably going to stabilize. So I think some of the best performing assets will be long bonds, gold, and Bitcoin. I think the stock market's going to have a pretty significant correction akin to 1930s, and it's a simple peak. In the meantime, we've got to have a lot more pain to reduce inflation. We'll get that. I think inflation is going to drop at extremely high velocity. People don't realize that yet. Like the base effect in crude oil, going from 50 to 130 is pretty significant. Going back down to 50 is what it's going to do. I think what Jeff Booth pointed out in his book, The Price of Tomorrow, of all kicking in. Hopefully, you won't have a nuclear risk out of Russia, Ukraine. If that happens, it tilts the world to a more extreme recession. It boosts prices like grains and T-bills, and who knows how bad that can get. So I think what's going to happen is risk assets are going to have to get real cheap. Housing should collapse. I mean, look what interest rates have done. And it's just a matter of time that all the lagging indicators follow that. I mean, inflation is very much lagging. I think everything is basically going to follow copper. It's down 24% in the year for a reason. Crude oil probably end up down 24%. And this is just what happened in 2008. But remember, that was just U.S.-centric. This is global. China is collapsing. First primary factor is the dollar. Gold has made new highs in terms of the euro and the yen, and virtually any other melting currency on the planet is doing what it's supposed to do. It's not doing well in terms of dollars in the U.S. because of what the Fed's doing. I mean, they've raised, 300 basis points? Gold's one of the best ones. I think it's going to do that. This is part of that sledgehammer from the Fed building a foundation for gold. I didn't think it'd get much below $1,700 an ounce, but again, I didn't think the dollar would collapse or rally 20% versus the euro and the yen this year. So to me, that's the key thing, and it's a matter of time that gold just keeps doing what it's been doing. But bottom line is you can't hold gold anymore without Bitcoin in that bucket. That's the way I look at it. It has to be in there unless you expect the world to go backwards, and not even backwards, but to go backwards in terms of digitalization. Because we could go backwards with wars and things like what's happening in Europe, but Bitcoin has its value if you're trading CDS and things like that. But in terms of the actual housing market value, I was one of my best trades ever. And calling that out when even Chairman Greenspan said, oh, we've never declined in the U.S. housing market over a full 1 year base. I'm like, it's simple. You pump too much and you dump too much. The U.S. is crushing it, will crush it. And China will not be able to catch up unless they change their regime to something less autocratic and more market sensitive. They're getting crushed. And I'd love to debate Mark Yusko on that. And this is a point I made about even before the invasion, that as soon as it became obvious they were going to invade, Cruel told us this, this is going to be the U.S. century. It tilts all the scales because China's pushed back on cryptos partly because their system does not allow it. Everybody in China wants to get access to the dollar from here. That's what I hear from people I know there in the Bloomberg connections. And why do they steal intellectual property? Because they have to. The dollar says that the Chinese cannot pick up, even catch up. Why do they want a CBDC? Because no one wants to touch that currency. I mean, I've traveled overseas in Europe. You want? Oh, you got dollars? It's just, to me, this is beginning of, I think China peaked in about a couple years ago. And literally, I've seen it before. We all remember. Now look where Japan is now. In the U.S., we have the advantage of the proper system in the right DNA. I mean, everybody in this country are coming here because they typically want to succeed. So I'll end with this. The one thing I really enjoyed about reading the book, 21 Lessons of 21st Century, 3 years ago by Yuval Noah Harari, is it's a very simple fact. You don't want to be bullish any country where no one wants to immigrate to and that's not tolerant. The number 1 and 2 countries where no one wants to immigrate, the massive ones in the country, but it's not in the world that are not tolerant, it's China and Russia. And why do we have problems with immigration in this country? It's because people want to come here. Like, I'm, descendant of European peasants. So I look at this as the U.S. century kicking in. Energy is a good example. Agriculture is a good example. And those are the basics. And now when we start, protecting our intellectual property a little more, among other things, I just view this as good luck, China. You're not going to, you have to get to a system where you have people telling you you're doing things wrong so you can check mark that. And we do a lot of that in this country.